Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. Well, it's not just currencies like euro or pound yielding to the dollar strength. We are observing big moves in other Asian currencies as well. The Thai baht depreciated to its November lows. The Indonesian rupiah and the Korean won hit 10-month lows. Dollar gold has not been having a good time either. JK, with this kind of weakness in the Asians, I'm keen to hear your thoughts and outlook for the rupee.
Good morning. Yes, we have seen the emerging market currencies catching up recently in the dollar strength. As the dollar yields have gone into, the 15-year highs, particularly on the longer end, and that's making the funds flow reverse back to the US because equities are seeing a minor bear trend, and we can actually see, investors are preferring the safety of US Treasury, which are giving a very good yield. So that is where we are seeing this weakness in the Asian currencies coming about. Of course, there are individual countries also which factors which play into it. Like Thai baht, we have some political, factors coming into play, and in Korean won, it generally following the Chinese yuan closely related to it, and so Chinese yuan weakness is also impacting the Korean won as well. But we are also seeing some of the stronger EM currencies like Mexican and Brazilian currencies, which have a high yield and which were the most favored currencies with Japanese and carry trade, and that is also reversed. In fact, some of their central banks are actually looking to weaken their currency, and that has helped the carry trade to be reversed, and these currencies have also seen some reversal. Now, coming back to current situation in the markets, yields made another new high yesterday, but we're actually stalling, possibly due to month-end, quarter-end approaching, and charts actually show some correction or consolidation in the yields that can keep the USD also rising further immediately. Data on the day was more weakness, and that probably more weakness developing in the economy, and that probably could have kept the yield somewhat suppressed. There was a successive second month fall in the consumer confidence number, 103 from 108.7 expected at 105.5, and consumers expressing concerns on political situation and interest rates. And the expectation index based on consumer short-term outlook for income, business, and labor market conditions declined to 73.7. And again, here 80 is the benchmark level that separates from recessionary conditions into expansionary conditions. So that's very significant. On the housing, we had home prices continuing to rise, influenced by higher input costs, but at the same time, home sales were down more than 8%, so not such a great news for the economy. Also impacting, the markets was the political stand-up that has continued on the passage of spending bills, increasing the threat of some of the government departments to shut down if no resolution is seen before September 30th. So if it does happen, thousands of federal workers will be furloughed, and a wide range of services will be suspended from Sunday. Of course, we have seen such shutdowns in the past, in 1981, and then also in 2011. They have not been as disruptive, but this time also possibly we will have earlier resolution. Even if there is a shutdown, it may be resolved immediately, because eventually political stake is high for all the groups. It's significant to note that Moody's has warned on Monday that a shutdown this time would have negative implications for the US government's AAA credit rating. And one should remember that Moody's is the only rating agency that has not downgraded US, while Fitch and S&P have already done that. European news was not encouraging either. 5 economic institutes are predicting the GDP in Germany to contract by 0.6% in 2023. So it's a year-on-year contraction. And following on with the recent technical recession that Germany has got into, and earlier their expectation was for a contraction of about 0.3%. All in all, the news was not good for the stock market. Equities were down. They got some momentum on the downside, with more conviction about higher for longer from the Fed, and yields continuing to rise into multi-year highs. The underwhelming economic data and the quarter-ending position also weighed on the markets. US indices ended more than 1% lower, and with each passing day of no resolution among politicians, government shutdown becoming a reality is also another negative factor. Significantly, the VIX, the fear gauge of equities, also surged and ended at its highest level since May 25th. The global equity index also lost 1%. We are seeing some sort of a stability, relative stability in the Asian markets today after China market rebounded with some strong official statements promising of more reforms, structural reforms, in fact, and also to keep the yuan, stable. Of course, we did have one of the Fed members, Neil Kashkari, saying that U.S. economy can achieve a soft landing, but there was a 40% chance that Fed will need to raise rates again to beat inflation. So it was not actually helping the market. So now on the currencies, we had the dollar index closing in on a very key level at 107 plus, which is the 50% retracement of its fall from 114.78 to 99.59, and that's an important level to watch out. And the equivalent level in the euro is at 1.05, which should be expected to hold. As we have been saying, the dollar is looking a bit overbought on the chart. Similarly, currencies are also looking oversold. So we should expect some bounce in the currencies in the coming sessions, but nothing to say that the trend has changed. The trend can only change with some strong positive news from any of these economies or from US economic more weakness that can actually increase the chances of rate peaking or earlier rate cut in the next year, but that's still some time away. We do have the inflation numbers later in the week, along with the GDP numbers for US that generally expected to be stronger as well. On the rupee, there was a consistent trade above 83.20 yesterday, and we did have offers from central bank. But the important thing to note is that the rebound from 80 to 85 levels on the USD INR has been driven by genuine demand, and that's the reason why central bank has not been as aggressively selling as they were seen before. The genuine demand, can actually take the dollar even higher. But we need to see whether the RBI will hold on to 83.30, not breaking. Possibly the year-end related selling, some selling that can come in the next two sessions, tomorrow being a holiday, can keep the things quiet. But looking at the RER and movement in other currencies which are weakening, our own export sector that needs support, and also the deficit that are increasing. One may expect RBI to relax their grip on the market, on the rupee market, and see some more weakness in the rupee, maybe in the new month, and it can be relatively quiet in today's and day after tomorrow's trading. So all in all, month end and quarter end approaching, and more of position adjustments will be ruling the markets overall. Thank you.
Thank you, JK. And just to quickly summarize, emerging market currencies are getting hit due to the dollar strength as well as the rise in yields, which are triggering some sort of reversal in the fund flows. US yields hit new highs yesterday, but the bond saw some buying, maybe due to the month-end related flows. Consumer confidence in the US fell, while the contraction in the German economy is expected to hit 0.6% this year by various research institutes. Inflation numbers along with GDP numbers for the US is expected during the week, so that will be something to look out for. And for rupee, we are comfortably trading above 83.20 as of now, and whether RBI will hold on to the 83.30 levels is something to watch out for. That's it from us today. Thanks for listening, and tune in on Friday to get the latest on the financial markets. Thanks for listening.